Welcome everybody to our video and webinar series presented by Nuwaru and Airwallex. In this series, we're taking businesses through the journey of scale up, expanding offshore and readying for IPO. This is part 2 of the series, and today we're going to talk about some of the employee related issues and some of the tax concessions that we can look to take advantage of. My name's David Early. I'm a corporate tax partner at Nuwaru, specialising in corporate tax, offshore structuring and employee share schemes. So on the agenda today, we're going to look at employee share schemes, and in particular, why would you want to introduce an employee share scheme? What are the different sorts of schemes that may be appropriate for your business, and what kind of benefits do the employees get out of participating in these schemes? Secondly, we'll move on to, are your people contractors or employees, and what are the tax issues and costs associated with each of those? So moving on to employee share schemes. So why would your business want to introduce an employee share scheme? Going back a few years, the government did a very detailed research paper on this, and interestingly, what that demonstrated was that small businesses through to medium businesses that have employee share schemes, relative to those that don't, consistently had a lower employee churn, higher sales, higher value added, higher labour productivity, and much higher value added growth. So seems pretty clear, but exactly how do they achieve that? Well, employee share schemes, of course, offer some tax benefits, so that's attractive to the employees. But they often have attached with them lock-in arrangements. So not only is the employee getting to participate in the upside of the firm, but there's a retention aspect to that, because if they choose to leave, then they will lose the shares and that upside that they've participated and contributed to. From an employer's perspective, not only, of course, you have those commercial benefits, but you have a cash flow benefit in that the cost of delivering shares to your employees versus salary doesn't come with a cash cost. So when cash is tight, that's a huge benefit for the business. Looking at these specific types of employee share schemes, broadly, there are 3 types. There's an employee share scheme that's designed for startup businesses. There's an employee share scheme which has what we call a upfront taxed treatment. And then there's the third type, which is what's called deferred tax scheme. The key differences around those are simply the timing of the tax bill that an employee will get from participating in those shares, and also the nature of the gain. Is it a capital gain or is it ordinary income? Clearly, a scheme that delivers more upside into the capital gain is preferable, because you can get the 50% CGT discount, halving the tax bill on the upside that you achieve. So first, let's have a look at the startup concession employee share scheme. Clearly, that's the preferred scheme if you can get within the rules. There's a huge tax benefit for the employees. There's no tax on grant, and all the upside on the share price is subject to capital gains tax, which has the benefit of being subject to the CGT discount of 50%, therefore effectively halving the tax bill for the employees. But there are strict eligibility criteria to fall within the concessions for these. On the employer side, first of all, the company must be not listed. It must have been incorporated for less than 10 years. It must have an aggregate turnover, together with any connected entities, of less than 50 million, and it must be an Australian resident company. If you satisfy all those criteria, you can offer a startup concession plan to your employees. However, within that, you can only offer ordinary shares or rights to ordinary shares. If you're offering ordinary shares, it has to be at no more than a 15% discount to the current market value. If you're offering rights or options, the strike price must be the current market value of the shares. Any employee participating in the scheme must not hold more than 10% of the equity in the company. If you want the concession, that doesn't mean the entire scheme doesn't work, it just doesn't work for that employee. And lastly, if you're offering shares, the scheme must be non-discriminatory. What does that mean? That means you have to offer it to at least 75% of the permanent employees of the company that have been with the company for at least 3 years. So secondly, then let's have a look at the upfront tax schemes. So if you're not eligible for the startup concession, you would probably first go to look at the upfront tax scheme. What do we mean by an upfront tax scheme? As it implies, any tax or any discount on the scheme is subject to tax upfront. So how generally the framework for employee share schemes works is employees will be taxed on the discount as if it's ordinary income, similar to salary and wages, but then any upside in the share price after that you realise on ultimate sale of the shares will be subject to capital gains tax. So if we offer shares at a 15-20% discount, whatever it may be, then that under an upfront tax scheme, that 15 to 20% will be subject to ordinary income tax in the hands of the employee. Any future gain beyond that, in the share price beyond that, when they ultimately sell, subject to capital gains tax. So if you have a company where you think there's a lot of share price upside, this sort of scheme would be preferable in that at least all the upside in the share price from the day of grant to when you ultimately sell will be subject to capital gains tax. It's only the upfront discount that will be subject to tax. There are a few ways you can deal with that as well, where you deal with the funding of the tax liability, if any, and that's through a loan-funded share scheme, a partly paid share scheme, or there's another scheme, an indeterminate rights scheme. So each of those will then mean that there isn't an unfunded tax liability upfront for the employee. And lastly, we have the deferred tax scheme. So as the name implies, we get to defer the tax. When does the tax deferred to? Under the deferred tax scheme, you won't trigger a tax liability until the risks of forfeiture and other restrictions on disposing of the shares are lifted. So that might be in 2 years, 3 years time. It's up to you, the business, how you design the plan. When that tax liability is triggered, the downside though, you think that's good because it's deferred and everyone likes to defer their tax bill, but the tax liability is calculated based on the market value of the shares at that later time. So if the shares have gone up in value considerably, then that gain between when you're granted the shares or the rights and options up until the date until you trigger that tax liability when your restrictions lift will be subject to income tax. Downside, that's at your full marginal tax rates, not at the discounted capital gains tax rates. Future gains beyond that taxing point, if you continue to hold the shares, of course, are then subject to capital gains tax. But what you've done when the share price is going up, you've shifted a lot of the tax liability into the income tax net rather than the CGT net, meaning you've got to pay tax at the full marginal rates rather than the discounted capital gains tax rates. So let's have a look now at what is the best type of scheme for you, the business. So really what it comes down to is, look, if you're eligible for the startup concession, you're always going to design your scheme to be within the startup concessions. It's clearly the best designed scheme tax-wise for the individuals. The issue, of course, you might recall from when we discussed the startup concession was that you are limited to offering a 15% discount on the share price, or if it's an option or a right, the strike price has to be the current market value. So it's only the upside from the time of grant that goes in. You can't really offer a material discount beyond the 15% to the employees. However, if you're in the startup concessions, there are some favourable rules around valuing the company, which are only available for startups. And under those, you can value the company at net tangible assets rather than using some other market valuation model. So under a net tangible assets model, for the most part, in startup land, the NTA is pretty low, meaning you can offer these out at a very low share price. Whereas under an ordinary scheme outside of those rules, you can't use the NTA valuation generally, meaning your valuation will be a much higher starting point for the employees. If unfortunately you're not eligible for the startup concession, well then we've got to look at what's the next best option for you. And really what that comes down to is, are you a newish business and you see a lot of upside in your share price, or are you a more mature business with a more stable share price? If you're a business that sees a lot of upside in the share price, you're going to want to push that gain into the capital gains tax net for the employees rather than defer the tax. So we're better to go for an upfront tax scheme, structure it in an effective way such that we can not have a unfunded tax liability for the employees, and then let the upside be subject to the 50% discount capital gains tax. If on the other hand you're a more mature business with a stable share price, then pushing the upside into the capital gains tax net is not as important. Rather, deferring the tax liability is more important. So we would probably go for a deferred tax scheme. It's just a lot simpler, because doing loan funded schemes or partly paid shared schemes, etc., to try and deal with the unfunded tax liability of an upfront tax scheme is quite complex. If that's not going to really deliver a lot of benefit, then let's go the simple option. We go a deferred tax scheme, in which case it's simple to structure. We don't have a tax liability triggered until 3 years, whenever it is down the track when the restrictions lift, and the employees don't have to worry about paying their tax until that point in time when they can sell the shares to raise funds to pay the tax liability as needed. So before we finish for today, I just want to touch on the contractor versus employee dilemma. Using contractors certainly has commercial advantages, particularly for small business. You only pay for what you use, right? You take on an employee though, and you've got to pay their salary on a permanent basis, and you've got all the various other labour law requirements around annual leave, etc., etc. So definitely commercially attractive to take on a contractor. But beware, taking on a contractor doesn't necessarily mean you don't take on the obligations of PAYG and SGC, or superannuation requirements. You may also, if you're above the threshold, be subject to payroll tax on their costs. So you need to be very careful around how it's structured to ensure you don't have those obligations, because they'll only come back to bite in years to come when the ATO comes after you. So how do you go about doing that? If you take on an individual as a contractor, there's a fair chance they're going to be considered employees for tax purposes. Unless they've got an established business, they're servicing multiple clients, and they can demonstrate that they're running a separate commercial business, they'll generally be considered employees. For example, if they predominantly work for just you and they're working under your instructions, that would generally be considered an employee for tax purposes, despite what they are contractually. There's a relatively simple way to generally overcome that, and that's to make sure there's an interposed entity. So for example, if you contract their service entity, be that a company or a trust, and then that company then deals with the individual, that is generally sufficient for SGC and PAYG purposes to ensure the liability doesn't get shifted to you as the employer or deemed employer. We can't say the same though when it comes to payroll tax. Unfortunately, there are look-through provisions. So even if you have that interposed entity, you may still be subject to payroll tax. Now that's subject to thresholds. In New South Wales, for example, you may not trigger a liability until your total payroll is above 1.2 million. But just bear in mind, even if you're not, you may approach that one day, and by contracting these individuals, irrespective whether it's through a service entity, you'll have a payroll tax later on. Now you might say, well, why do we have to worry about this? Everyone takes on contractors. No one takes tax out. It's the standard market practice. Well, it may be the standard market practice, but unfortunately doesn't make it right. And there's just been a recent number of cases go through the courts, and the ATO has won those cases pretty much on all occasions. So this is an ATO focus area. They will come after you, and you will be stuck with a big SGC bill down the track. And unfortunately, there's no time limit on how far they can go back to collect that SGC, and there's serious penalties on top. You may also have a PAYG liability, particularly if the individual hasn't declared the salary and wages. They'll get you to pay the tax for them. And even if they have paid the tax, so you're not up for the actual PAYG, you'll be up for penalties. So be careful. It's a cost you really don't want to bear in the business, all for the benefit of the individual, not your business. So that's it for today. Thanks for listening. I hope that gives you a bit of an insight into some of the considerations around employees and their role in your business as you're scaling up. Next week, we'll be running part 3 of our series. We'll be talking about offshore expansion and other related issues associated with that. Look forward to seeing you all then.